Welcome, everyone. Thank you for joining me today. In this lecture, we will study the role of financial management in the firm. This is one of the most important starting points in finance. Why? Because every organization has limits. A firm may have many good ideas, many exciting projects, and many possible opportunities. But usually, it cannot do everything at the same time. Money is limited, time is limited, managerial attention is limited, risk tolerance is limited. So managers must decide which opportunities deserve resources. They must decide which projects to fund, how to fund them, how much risk to accept, and how to measure success. That is where financial management becomes essential. Financial management is not only about saying yes or no to spending, it is about making disciplined decisions. It helps the firm allocate scarce resources wisely. Financial management is the process of making investment, financing, and operating decisions that affect the firm's cash flows, risk, liquidity, and long-term value. In simple words, finance helps managers answer a powerful question. Will this decision make the firm stronger, more valuable, and more sustainable? That is the foundation of today's lecture. Let's begin with why financial management matters. Imagine a firm considering a new product, a new location, or a major equipment purchase. At first, these ideas may sound attractive. A new product may increase sales. A new location may reach more customers. New equipment may improve efficiency, but finance asks deeper questions. How much cash must be invested first? When will the cash come back? How risky are the expected results? Can the firm afford the project without creating financial stress? Would the same money create more value somewhere else? These questions matter because business decisions involve trade-offs. A firm may have 10 promising ideas, but enough capital for only 3. Financial management gives managers a framework for choosing carefully. It connects ideas to numbers. It connects strategy to cash flow. It connects growth to risk. It also connects today's decisions to tomorrow's value. The goal is to spend wisely. A firm that avoids every risk may fail to grow. A firm that accepts every risk may fail to survive. Good financial management helps the firm find balance. It supports growth, but not reckless growth. It supports investment, but not wasteful investment. It supports ambition, but with discipline. Now, let's talk about the role of the financial manager. The financial manager helps the firm make decisions that create value while maintaining flexibility and controlling risk. In a large corporation, this role may be shared by many people. There may be a chief financial officer, a treasurer, a controller, risk managers, financial analysts, and investor relations professionals. In a smaller firm, one person may perform many of these duties. But regardless of firm size, financial managers usually focus on 4 major decisions. The first is the investment decision. This means deciding what assets, projects, products, or strategies the firm should invest in. Should the firm open a new location? Should it replace old equipment? Should it build a new technology platform? Should it acquire another company? These are investment decisions. The second is the financing decision. This means deciding how the firm should raise money. Should it issue bonds? Should it issue stock? Should it use retained earnings? The third is the payout decision. This means deciding whether cash should be returned to owners or kept inside the firm for future growth. The fourth is the working capital decision. This means managing short-term items such as cash, receivables, inventory, payables, and short-term borrowing. Together, these 4 decisions shape the financial life of the firm. Let's look more closely at those 4 decisions. Investment decisions are about where the firm puts its money. These decisions are especially important when they involve long-term assets or major strategic projects. In finance, we often call these capital budgeting decisions. The word budgeting here does not mean only cutting expenses. It means evaluating whether a long-term project is worth the capital required. Financing decisions are about where the money comes from. A firm can use debt, equity, retained earnings, or a combination. Debt means borrowed money that must usually be repaid with interest. Equity means ownership capital. Retained earnings are profits kept inside the firm rather than distributed to owners. Each financing source has advantages and disadvantages. Debt may be cheaper, but it increases required payments and financial risk. Equity may provide flexibility, but it can dilute ownership. Payout decisions are about what to do with profits. Should the firm pay dividends? Should it repurchase shares? Should it keep the money to fund future projects? Working capital decisions are about daily financial survival. A profitable firm can still struggle if it runs out of cash. So, managers must decide how much cash to hold, how much inventory to keep, how quickly customers should pay, and when suppliers should be paid. These everyday decisions may look small, but together they keep the firm moving. Financial management does not operate in isolation. It connects many parts of the firm. It connects strategy, accounting, operations, marketing, human resources, and external capital markets. Think about a marketing campaign. The marketing team may ask, will customers respond? That is an important question, but the financial manager adds more questions. How much cash must be spent before the sales arrive? How uncertain are those sales? What is the contribution margin on the new sales? Will the firm need more inventory? Will customers take longer to pay? Could the campaign reduce sales of an existing product? Does the expected return justify the risk? This is an important principle. Finance does not replace strategy. Finance tests whether strategy is economically sustainable. A strategy may sound exciting, a product may look innovative. But the financial manager asks whether the idea can create value after considering cost, timing, risk, and capital requirements. This is why finance is so useful across the organization. It does not belong only to the finance department. Every manager benefits from understanding finance. Marketing decisions have financial consequences. Operations decisions have financial consequences. Hiring decisions have financial consequences. Strategic decisions have financial consequences. Finance helps everyone see the economic impact of their choices. Financial managers perform several roles at the same time. First, the financial manager is a steward. A steward protects the firm's financial resources. This includes maintaining liquidity, supporting accurate reporting, managing risk, and making sure resources are not wasted. Second, the financial manager is a strategist. A strategist helps decide which growth opportunities are worth pursuing. This may include product launches, acquisitions, pricing decisions, expansion plans, and long-term investment projects. Third, the financial manager is a capital allocator. Capital is limited, so the firm must choose. One project may be attractive, but another may be better. One department may want more funding, but another department may create more value. The financial manager helps compare these choices. Fourth, the financial manager is a risk manager. Firms face many risks: cash flow risk, interest rate risk, exchange rate risk, commodity price risk, customer credit risk, leverage risk, operating uncertainty. The financial manager identifies these risks and helps the firm manage them. Fifth, the financial manager is a communicator. Finance must be explained clearly to executives, employees, lenders, investors, board members, regulators, and other stakeholders. A good financial manager does not only calculate numbers. A good financial manager explains what the numbers mean and why they matter. Finance is often described as the language of business. That is a very useful idea. Different departments may speak in different terms. Marketing may focus on customers, demand, and brand awareness. Operations may focus on efficiency, capacity, and production quality. Human resources may focus on talent, compensation, and retention. Accounting may focus on recording what happened during the period. Finance translates these different perspectives into a common language. That language includes cash flow, risk, return, liquidity, cost of capital, and value. Let's translate a few examples. Marketing asks, will customers buy the product? Finance asks, will the product generate enough additional cash flow to justify the investment? Operations asks, can we produce efficiently? Finance asks, will efficiency gains reduce costs enough to increase value? Strategy asks, does this fit our competitive position? Finance asks, does this strategy create long-term value after considering risk and capital needs? Human Resources asks, can we attract and retain talent? Finance asks, do compensation and staffing decisions improve productivity, reduce risk, and support sustainable performance? Accounting asks, what happened during the period? Finance asks, what do the results imply about future cash flows and financial flexibility? So finance creates a bridge between ideas and decisions. It asks whether an idea is not only attractive, but economically justified. One of the most important lessons in finance is that accounting income and financial value are not always the same. Accounting focuses on recording and reporting past performance according to accounting rules. That is extremely important. But finance focuses on decision making, future cash flows, risk, and opportunity costs. A project may increase accounting earnings and still fail to create financial value. How can that happen? It can happen if the cash flows arrive too late. It can happen if the cash flows are too risky. It can happen if the project requires too much capital. It can happen if the project earns less than investors require for the risk taken. It can also happen if the project prevents the firm from pursuing better alternatives. This is where opportunity cost becomes important. Using resources for one project means those same resources cannot be used for another project. A project creates financial value only if the expected benefits exceed the full economic cost of the resources used. And we must consider timing. We must consider risk. We must consider alternatives. Later in finance, this idea becomes more formal when we study present value, net present value, and the cost of capital. For now, remember the main point. Profit is important, but value creation is deeper than accounting profit. Finance asks whether the decision truly improves the firm's economic position. When evaluating a business decision, managers can begin with a basic financial decision framework. This framework is simple but very powerful. First, cash flow. What cash will the decision generate or require? Second, timing. When will cash inflows and outflows occur? Third, risk. How uncertain are the expected cash flows? Fourth, required return. What return is necessary to compensate investors for the risk? Fifth, financing. How will the firm pay for the decision? Sixth, liquidity. Will the firm still have enough cash to meet its obligations? Seventh, flexibility. Does the decision preserve future options or does it limit them? Eighth, strategic fit. Does the decision support the firm's competitive position? Ninth, stakeholder impact. How does the decision affect employees, customers, creditors, communities, and owners? This framework helps managers see trade-offs. A decision can be profitable but risky. A decision can support growth but require too much cash. A decision can be strategically attractive but harmful to liquidity. A decision can improve short-term results but reduce long-term flexibility. Finance helps managers avoid looking at only one side of the decision. It encourages disciplined thinking. It asks not only can we do this, it asks should we do this, and if we do it, how can we do it wisely? Before we finish, let's place financial management inside the broader field of finance. Finance has three major areas that are closely connected. The first is corporate finance. Corporate finance studies financial decisions made inside firms. It asks which projects the firm should accept, how much debt the firm should use, how much cash it should hold, how risk should be managed, and how value should be created. The corporate finance perspective asks, what decisions should we make? The second area is investments. Investment studies decisions made by investors. Investigators may be individuals, pension funds, mutual funds, insurance companies, endowments, hedge funds, private equity funds, or other institutions. The investments perspective asks, should I provide capital to this firm, and what return should I require? The third area is financial markets. Financial markets and institutions connect firms that need capital with investors who supply capital. These include stock markets, bond markets, money markets, bank lending markets, private equity markets, venture capital markets, and foreign exchange markets. Financial markets influence borrowing costs, stock prices, credit conditions, liquidity, valuation, and access to capital. So these three areas work together. Corporate finance focuses on decisions inside the firm. Investments focus on decisions made by capital providers. Financial markets focus on the system that moves capital through the economy. As you continue studying finance, you will see these connections again and again. Thank you for joining me today. I look forward to seeing you in the next video.